Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, "The ultimate in real estate is being the bank." And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Today, we're going to get into this topic on how you can actually become your own bank. This is a 200-year-old strategy. It's been utilized by the wealthiest families in history to minimize their taxation, pay off debts, and build generational wealth. And the concept is all about how you just own your own bank, become your own bank, and finance things through your own bank. Now, whenever I speak to a group like this, for example, I'm always thinking in my head, I want you guys to know what you're going to get out of today so you don't waste the next hour of your life on something that you don't even know what you're going to get out of this, right? And so when I'm at an event and someone gets on stage and they tell me, hey, here's what I'm going to talk about, I really appreciate that. So I'm going to start with this. There's four things I want to talk about today. One is protection, because why wouldn't you want to protect the money you earn? Two, we'll talk about tax-free growth, because why wouldn't we want to make smarter money moves? Third, leverage. Because we have tools, we have opportunities, we have money, we have people around us, networks around us that we need to be leveraging better. And legacy, because we need to teach this to our legacy, to those around us. So I have a system that will help you guys accomplish and get all of those things. So if you guys could take that blueprint home with you guys today, would you guys say that's worth your time? So as I get into this, I want to share briefly just a little bit about myself so you have some confidence in your speaker today. I'll try and be quick. There it is. A little bit about me and how I ended up here. I was blessed with some amazing mentors in my life. I grew up around this stuff. My dad runs a successful self-directed IRA company, if you guys know what that is. Their company's handled over $1 billion of transactions. This is a couple photos of us speaking at different events and podcasts and stuff like that on stage, which is pretty cool. But as I was starting my career, I was kind of following him, tagging along into some rooms and networks that he was a part of. But guys, these places were not, these networks were not people that everyone gets to meet or get to know. This was very secluded and intimate groups that most people never get access to in their whole life. I was naturally curious. I was loving and learning this stuff. And I kept finding ways to be in those rooms and actually watching how wealthy people were building wealth in the real world, not just on social media and what they were saying out loud. And so this led me to a couple other incredible mentors of mine, guys like you see here, some professional salespeople, real estate investors, private lenders, entrepreneurs. I followed their strategies. I started doing deals with people in their network. I started to build a real estate portfolio on my own. I became a top sales rep at a massive brokerage. I taught people about personal finance, cash flow management, banking. You know, I wasn't just observing these strategies, but I was implementing them myself. And so as I spent years around these people, though, something started to bother me. Every strategy had a missing piece. I didn't know what it was. I couldn't figure it out. And I wanted to build something that, I could teach this missing piece to all of their networks and people. And I didn't want to take away from what they were already doing. I wanted to enhance it, but I couldn't quite figure it out until I ran across this strategy I'm going to talk about today. It's called And that missing piece was the infinite banking concept. And so this is what we'll get into today. IBC it stands for. And really, over the past few years, I've met with over 3,000 families across the country, teaching them this wealth building concept. And this has allowed Anna, my wife, and my son Wells and I to travel the world, build a real estate portfolio, and build really the perfect foundation for a family to not just be rich, but build generational wealth, which is what everyone strives for. And so I'm super excited today to teach the infinite banking concept and give you guys that missing piece. So to start, let's talk about banking. What is banking? If we're going to become our own banks, then we need to understand what banking is. So banking is a massive paradigm shift for most people once they start learning about it, because banking affects every single component of your life. Whether you understand it or not, it's going to play a role in your financial life. So wouldn't it be smart for us to learn a little bit about the banking function in our life and how people apply it? Well, what's banking? Banking is the business of protecting money, okay? Super simple. So throughout this presentation, I want you guys to have an open mind, because once you see the banking world and how it actually can complement your life instead of going against you, you'll never look at money the same way again. And so banking, again, is the business of protecting money. Think about that. What is the verb form of banking then? Meaning, if you were to actually do banking, the act of banking, what does that mean? Right? Well, banking is actively protecting money, depositing money, and lending money. So again, wouldn't it be smart to learn how to do and control the banking in our life if protecting, depositing, and lending money is what it is? You don't want to be protecting money with you don't want someone else to protect your money. You don't want to have someone else deposit and use your money. You don't want to be using someone else's lending opportunities. Why wouldn't you want to be in control of that? And so when we're diving into this strategy, let's talk about banking. Let's talk about what banks do. Let's build that foundation of an understanding first, and then let's dive into how you can be your own bank. Now, what do banks do? Let's say you had a bank that was awesome. They paid you 4% on your deposits every single year forever, okay? 4%. Now, let's say you deposited money in that bank. We'll use this $100,000 deposit as the example. But guys, use any number you want. If you have $1,000 you want to deposit into a bank, or 100,000 or 10,000, whatever you want, okay? So you deposited money in a bank. What does the bank then do? Well, that money sitting in their accounts is a liability to them because they owe you interest on it. So they need to go invest and produce a return, turn that into an asset. And so what do? Well, they lend that money to somebody who's maybe buying a house. And that person buying the house is probably gonna have a mortgage at 7, 8%. Now the bank's making a spread. They're lending your money to somebody else, making that 7% on the mortgage, and they're paying you for it. Again, making a spread. We all know how this works. This is not new, I don't think, to most people, but here's the part that might be interesting. What does the seller do? When you buy the house, or someone buys a house, whoever was selling that house, when they get all of their proceeds back, what's the seller gonna do with their money? Well, just put it back in the bank, right? So the bank actually never lost any money because they gave it to the home buyer, and the seller just put it back in for them while the bank's making 7% on it. Whoa, right? That's crazy. And what's the bank going to do now with the seller's funds deposited in their bank? Probably lend it out to somebody else, right? So if they lend it to somebody else on a car note at 8%, now they're making the spread there too. And if the car was purchased and you paid the car dealership for the car, again, where does the car dealership put their money? Right back in. So you can start seeing how the banks are controlling all these transactions. They're making so much money on your deposit, right? A couple more scenarios. What if that bank then lent it to somebody on a home remodel loan at a 9% interest rate? They're probably going to pay their contractor. Where's the contractor leave their money, right? Maybe someone else needs a debt consolidation loan. Who's going to pay off their credit cards? Credit card companies or the bank. So just put it back in. So guys, who's in control of all of these transactions, making profit the whole dang time? Yes, the bank. Well, you're making 4, they're making 7. They're making a 3% spread. Okay, that's modest. Well, you're making 4 though, they're also making 8. They're also making 9. They're also making 12. So if you add all of that up, they're making 3% more than you on the house, 4 on the car, 5 and 8 on the debt consolidation loan. They're making 20% more than you are. So how many times, though, if we actually look at this math, does 4% go into 20%? Think about that. How many times does 4 go into 20? 5, right? 5 times. So if you're making 4 and they're making 5 times more than you are, doesn't that actually mean they're making 500% more than you are on your money every single year? That's exactly what that means. So guys, if you were to go look up BauerFinancial.com, you will find that banks make between 400 and 1,300% more than you do every single year. You can actually get any bank's annual reports from any year in history. It'll show you exactly how much more banks are making than you. There isn't a bank in the world making less than 400%. So when the government comes out with stats like this, the Social Security Administration came out with the stat a few years back, they said 5 out of 100 people will be financially secure at retirement age. Soak that in for a second. 5 out of 100, not rich, not crushing it, just comfortable, just secure, just barely enough. Guys, in the land of America, the United States, the land of opportunity, the great country we live in, how many of you guys would agree that something is wrong with this? That means 95% of people are going to be working until they're 70, 80, working 2 jobs, moving in with family, because they just can't afford it. Not because they want to, because they have to. And who's at the center of all the financial transactions in this country, guys? Wall Street, banks, the Federal Reserve, they are in control of all of the financial transactions. They're crushing it and happy like this. So when I first learned this strategy, I learned this strategy from a book called Becoming Your Own Banker. It's a fantastic book. Everyone should read this book. Now, in this book, the guy named Nelson Nash who wrote it, he teaches a lesson. The main lesson of the whole book is that you finance everything in life. Now, when I first heard that, I didn't fully understand it. So I'll clarify for you guys in case you don't either. What do you mean by you finance everything? Well, it means you either borrow money from a bank to purchase something and you pay them interest on it. Example, car. If you get a car note, car loan, borrow the money from the bank and you pay them interest on that car loan. Or maybe you're a Dave Ramsey follower and say, I don't take loans, I buy things cash. Okay, great. Let's say you buy a car cash. Guess what? You now used your own money and you gave up the interest that you could have earned. That's an interest cost too. And that interest cost lasts forever, not just a couple years, forever. You lost the ability to earn interest on that money for the rest of your life because you spent it. And so if you apply that math to every big purchase, every big investment you make, that's the cost of not being your own bank. That number becomes so substantial when you know how to apply it in every financial decision you're making. And the problem isn't just that you finance everything in life. The problem is that you finance everything in life with other banking organizations. Because guys, you have to finance things. There has to be a way to buy something. You have to buy something somehow, right? You need money to do it. But how can we be the banks we're doing financing with? Right? Does that make sense? We're the one making the spread the whole time. We've been taught to get into business or invest, but the bankers are the ones controlling all of the flow of that money. Whether we pay cash or we finance it doesn't matter. They are at the core of it, collecting, controlling, and just making insane profits off of all the hard work that we do. And so this is why you need to become your own bank. So you can be in control of all of these transactions. So you can be the one earning interest always. Now, I promised you guys today that I would teach you how you can become your own bank. So let's get into that. Now that you understand the framework of why we would want to do that. And if we're going to start our own bank, we're going to become our own bank, we're going to take over the banking activities in our life, then we need a better environment to store that money. We need a new bank, right? And when I first learned this strategy, this was a question that I came across that made me stop and think. I ask you guys to do the same. Could it be possible, guys, that there are more efficient environments to store wealth outside of commercial banks that you're not aware of? Guys, the more I learned about money, the more I realized I didn't know. Probably thinking the same thing if this is your first time on this, our presentations today. There's always something new to learn. And so when I pose this question, people really stop and think about it. So what is your bank? If there's a more efficient environment to store wealth, then what is it? Where can we store it outside of the commercial banking system? Well, and when I say what is your bank, I mean anytime you ever needed to buy something or invest in something or rehab something or buy a car, or save money somewhere, it's going to come from and flow through your bank. So you're going to set up a new bank. And how do you want that bank to operate? If we're going to set up our own bank, what would be some helpful attributes that your bank would have? And I want to compare this to some traditional banks so you can kind of see the difference of what you'd be setting up. So again, if we're going to set up our own bank, we're going to store money here, finance things with it, then of course it needs to be liquid. You can't set up a bank that you don't have access to your money, or there's too much in costs where you don't access it. That's not helpful. So we need liquidity first and foremost. If your bank has liquidity, awesome. Now we're matching what a traditional savings account does. All the savings account is just a liquid place to put money. Okay. So that now is matched. Second would be growth. Wouldn't you want growth on your bank, right? Traditional savings accounts today earn 0.07%. That's the average. What if your bank was going to earn 2, 4, 5, 6% uninterrupted and compounding every single day, every single year of your life? That would be awesome, right? That'd be a pretty nice bank. No matter what happens in the economy, to always be growing. That's not very usual, right? And two, that little tiny growth you gets taxed. That's stupid. What if your bank grew tax-free? That would be awesome. What about protection? If you were ever in a lawsuit, judgment, lien, in some states, bankruptcy and divorce, what if it was protected against all those unforeseen future events? That would be awesome. And last, stability. What if your bank was stable in all times of economic uncertainty, no matter what happened in the world? Stable. Guys, in 2008, 364 banks in America went bankrupt. Couldn't get your money out. That's a problem. And that's where you're choosing to store your money? Bad decision. What if your bank was stable at all times? Now, looking at this list, guys, if your bank could do all of this, wouldn't this be a more efficient place to store money? This could be a place you could control, you could count on, you could use as the foundation to finance everything throughout your life, right? And I get it, guys. Being a business owner, employee, have a big family, you don't, like, life's crazy. There's so many things pulling for our attention right now. You're caught up in the chaos. So the opportunity to actually put money somewhere that was still liquid but had all of these attributes, that would be just peace of mind. That would be comforting at the least. Now, that's something everybody in this country, I think, should be diving deeper into, better understanding. Wouldn't you guys agree that if you could put your money in a place that did all of this, that you would, right? So if we're going to set up this bank now and it has all these attributes, I like to look at it now as like a vehicle. It's a place we're just running our money through, not an investment itself, not a product we buy to grow our money, but as a vehicle to just store money and finance things. That's what this bank is going to be, just like your traditional savings account. And so before I tell you guys what this bank is that we're going to set up, I want to read a quote to you. The quote is, "The problem in America isn't so much what people don't know. It's what people think they know that just ain't so." So guys, internalize that here. What you might think or know might not be the case, especially with this next slide. The bank that we use to do banking is none other than a dividend-paying whole life insurance policy from a mutual company. Boom. Life insurance. How many of you guys thought that was going to be the bank? Guys, this is the point in which people get maybe skeptical because they're like, hey, I've heard of life insurance. I have life insurance. I did not know it could do this. Or when I talk to my broke brother-in-law who sells insurance, he doesn't teach me this. When I go to my local insurance agent who I've trusted for so long, he doesn't teach me this. Yeah, because they don't know. They specialize in one thing. We specialize in another. We teach banking. If you want banking help, go to a banking professional. That's what we do. Guys, this is not a regular insurance policy. This is a specially designed and engineered whole life insurance policy. And a lot of people have questions when they first learn it because they know Dave Ramsey says, buy a term and invest the difference. Whole life's crap. I'll agree with him. If you want regular life insurance, do that. But if you're looking to build a banking system, totally different conversation. This is a specially designed and engineered whole life. And the way I look at it, another analogy I use to teach people who first learn this is I look at the policy like a car. You guys ever gone to a car dealership or just driven around town and seen a Ford Focus? This is a Ford Focus on the screen. Very basic, simple car, nothing special, okay? Ford Focus, it's a good car, right? Well, if you go on YouTube and look up Ken Block, you will see him going 140 miles an hour, drifting around a turn in a Ford Focus. But it is this Ford Focus. So what's the difference between these two cars? Same car, just the design and engineering of the vehicle. So if we're going to use whole life as a vehicle to do banking, it just needs to be specially designed and engineered. And the way we design the policies is we make it look more like a supercharged bank account than anything else. So, 2 minutes ago when I asked you guys, do you think and would you agree that if there was a place to put your money that had all of these attributes and benefits, would you? Yes, you would. right? We all agree that's what we'd want. Well, that's what this whole life policy can do if it's structured correctly. That's what it can be. You might just have not learned how to do that or set that up yet. That's what we're going to get into today. And so when I first learned this myself, I was, maybe a little hesitant because I'm like, I knew what life insurance was. I thought life insurance was a low rate of return vehicle. I thought life insurance was expensive. I thought it was the worst investment ever. I heard someone say that one time. Well, if you guys are taking notes today, which I encourage you to do so, here's the point that I definitely need you to remember. Write this down. Whole life is not an investment. It's not. It has nothing to do with investing. It's actually considered a alternative asset class than investing, and it's a permanent life insurance vehicle. If you read the actual contract of the policy, everything's guaranteed. Guaranteed cost of insurance, guaranteed death benefit, guaranteed growth, guaranteed cash value. There is absolutely zero risk. That means it can't be an investment. And so when you guys go home today or talk to your neighbor, your business partner, your buddy, your spouse, and they tell you, oh, no, don't do that whole life thing. It's a terrible investment. It's got such a low rate of return. Do what Dave Ramsey says and buy term and invest the difference. As soon as you hear someone say that, you now know they have no idea what they're talking about because they can't even correctly identify what type of asset that whole life is. Okay? And again, you cannot get a policy built like this from a regular insurance agent or financial advisor. You only can get policies like this from banking professionals. So guys, listen to people who actually know what they're doing, mimic what banks do. And if we're going to mimic banks, remember, these are the attributes your policy will get you. It's liquid, it's guaranteed to grow, it's tax-free, it's protected, it's stable, has a death benefit to protect your family in case something happens to you. You don't get any of that in any other bank, okay? Now, who uses this? Maybe you're thinking, this is just for rich people. Well, here are some rich people who have done this. Mr. Rockefeller on the top left, he built one of the wealthiest empires in history through this strategy. Top right, Walt Disney. How did he start Disneyland? Oh, through this strategy. He took a loan from his whole life insurance policy to start Disneyland. Interesting why he did that. These two billionaires on the top, on the bottom right, you guys both, or you all know both of these two people, I would assume. These two guys alone have over $1.2 billion in life insurance. And these two guys on the left, you all know these politicians, both polarizing in their own way. Both of them incorporate the strategy. That's how both their families have built this wealth. So if these individuals are using this, who else is? An interesting thing is that the number one purchasers of these whole life insurance policies in the world, not these guys actually, despite what you would think, the number one purchasers of these policies in the world are banks. Interesting, right? Look this up. BOLI, bank-owned life insurance. Go ahead and Google it. These four banks alone have over $60 billion in whole life insurance. You will find, if you look up BOLI, that banks own more whole life insurance, not IULs, not variable universal life insurance, not any other term or other life insurance product, whole life, than they own in land and buildings combined. Banks are the number one purchasers in the world. And not only are they the number one, they buy more every single quarter, every single year. So you need to ask yourself, are banks stupid or do they know something that I don't know? Someone asked, some people say that Disney took a loan from his IUL policy to start the business. IUL life insurance agents say that they can use IULs to do banking. Little tidbit for you, they're scammers. They are liars. IUL was not even invented when Disney started Disneyland. The IUL product is like 20 years old. So how could they have started, or how could Disney have used an IUL to start his business? It wasn't even a product. It wasn't even invented. It's a lie. Anyone who claims they use an IUL to do banking is wrong. They're just selling you a product because it's the highest commissionable product they can. They don't actually know. Those of you who know what banking is, if you actually want to teach banking and be a certified infinite banking educator or a teacher, you have to go through a pretty extensive course through the Nelson Nash program. They will teach you and you will learn very in depth that if you use any IUL or universal product to do this, you will be kicked out and you will not be allowed to say you're an infinite banking educator. It's not a thing. Of course, people who are not educated and actually teach banking understand that. If they're just a regular insurance agent, they'll probably sell whatever they can to you and tell you whatever they can. But if they're actually a banking professional, they would never sell you an IUL because they're actually not allowed to because it's against the rules. It wouldn't even work. Too much risk. So glad you asked that. I actually was going to hit IULs at the end of this because people have been asking about that lately. IUL is not a bad product. It's just a different product. It's not meant for banking. It's meant for investing. It's a 401k alternative. Okay. One thing you don't get in an IUL, one thing you don't get in other markets is compounding interest. Okay. Let's talk about that. What is compounding interest and what is uninterrupted compounding interest? Well, I'll use an analogy or riddle to kind of explain this point. Would you guys today rather have $1 million in hand? Or what if I gave you a penny today? But that penny doubled every single day for 30 days. Okay. What would you choose? The penny that doubles or the $1 million today? You got 30 days for that penny to double. Most of you will probably choose the penny. Let's see what that math does. This is the math. If you had a penny that started at 1, day 2 was 2 pennies, day 3 was 4 pennies, 8, 16, 32, etc. By day 30, your penny would be doubled to $5.3 million. That is a whole lot more than $1 million you could have got on the first day. Let's stop for a second and just appreciate what compounding interest can do for you. The fact that it would double all the way to $5.3 million is crazy to me. I'm sure you've heard this, but Albert Einstein said that the 8th wonder of the world is compounding interest. And not just compounding, but uninterrupted compounding interest. Now let's talk about what if it was interrupted. That's a huge difference maker, and you'll see how. Let's talk about compounding, but if it was interrupted with a fee. Let's say that you, and we all have places we put money. Examples, your 401k or a money market account or your financial advisor. If you give money to those accounts, they charge a fee. And usually it's 1 to 3% that they charge you every single year on your account value. If we just had a simple 2% fee on your asset, and your penny doubled every day for 30 days, but it had that 2% fee, the penny would only double to $2.9 million. That 2% fee would have just eliminated over $2 million of compounding. That's interesting. Does 2% of 5.3 million sound like 2.9 million? No, you're missing something. You're off. A 2% fee, and this is just the point, is uninterrupting or interrupting your compounding growth with a fee has massive consequences to your long-term wealth building. The second scenario we'll talk about of interrupting your compounding is a withdrawal. What if you withdrew money from your penny on day 15 and day 25 and just $100? What if you withdrew $100 on day 15 and $100 on day 25? So you only withdrew $200 from the entire system, okay? If you withdrew $200, the compounding would only get to $2 million. That penny would have only gone to $2 million and you would have put in, taken out just 200. So a withdrawal would extremely eliminate your compounding growth. Last, but another simple scenario is taxes. If you had a 15% tax on that penny doubling, it would only double to $500,000. Guys, how many of you would agree that there's some of the places that we put money, we've been taught to put money at least, have all 3 of these things attached to them, interrupting your compounding? A 401k is the easiest example. They're going to charge you tax no matter what. It's going to happen, okay? There's going to be a management fee every single year. And they will let you withdraw the cost basis whenever you want. And they recommend you to if you're in a financial crisis. So, well, now, if all 3 of those things were happening against your money all at the same time, you'd have almost nothing at the end of the day. But they pitch you on, oh, but we give you a match. Oh, we'll double your principal you put into it. So you're going to grow so much over time. Not true, because all 3 of these things are going against you. It's all a lie. It's the financial system controlling your money. They're making way more money than you are. And guess what type of account? Guess what type of bank would allow you to not have taxes, have no percentage fee, and no withdrawals ever, so that your money could always compound uninterrupted forever? Who would actually let you put your money somewhere and let it sit there and do that? Guys, these specially designed whole life insurance policies do just that. Your dollars sit and compound always. So now that we've laid the framework for you of the power of life insurance, specifically whole life, the credibility behind it, not other products, what banks do and how they operate, and why you'd want to become the bank, and now you know uninterrupted compounding interest is a massive factor here. Let's go put all this into action. Okay, let's go put this into action and give you a real life example of how you can use whole life as a bank. And I want to use buying a car for the example. Let's just say you're going to go buy a truck. Super easy. You want to buy the truck cash, but you want to run it through your bank first. Now, before I show you those numbers around how all that would work, let's show you just the simple scenario, or not scenario, but just the simple topics that need to be understood first and foremost. First is premium. Let's talk about the machine as we use this. So when we look at the vehicle, and you're paying a premium for whole life insurance, a lot of people look at whole life insurance as an expense, just like they look at all their other insurance products. You might look at your health insurance, home insurance, car insurance, and you look at these different insurance products and you think, oh, this is an expense. Fair for other products, but for a whole life, it is not. Because if you put that money in the policy and it's still liquid and it's growing, that doesn't sound like an expense or a premium. That sounds more like a deposit. So if your insurance policy is structured correctly, it is exactly that. It is a deposit because you can immediately use it if you needed to. So start looking at the policy and how you're funding it and contributions into it as a deposit. And then next, let's talk about age. Some people, when they get into this, they think, I'm too old to do this. That is most likely not true. Age does not matter. Think about it this way. If I put $10,000 in a savings account or my grandma put $10,000 in a savings account, it's still $10,000 just because she has a bigger age number than mine. It's still 10 grand. It's no difference. If we invested in the same investment, it's still the same rate of return despite our age difference. So the policy is the exact same way. The difference would be the older you are, the less death benefit you would have. And we're not setting this policy up for a death benefit anyways. Obviously, life insurance was designed to have a death benefit and protect you. There is definitely value in that, and you will have that attached to this. However, we're not building the policy for a death benefit specifically. We're building the policy to do banking, and it just has a death benefit attached to it, which is another benefit you'd get from banking with a life insurance policy versus banking with an actual bank. So now that you understand these three things, let's go into a real life example, again, of buying a car. This is where a lot of numbers come into play, and sometimes it's confusing, sometimes it's super simple, just depends, how you can understand it or what you've heard from us before. I'm going to go through this step by step. Stop me where you have further questions. $10,000 deposits every year. This was an individual who said, hey, I can save 10 grand a year, about $800 a month. So again, if you think you need to be ultra wealthy to do this, that is not true. This individual just saved 10 grand a year, $800 a month. Super simple. And their cash value over here on the right, the cash value is what you have access to access or use, or it's another word, your equity. So this cash value is what's available inside of the policy. And then again, also there would be a death benefit attached to this as well, obviously. Now, what if a couple years into the policy, you think, hey, I want to go buy this dang car. So you take a loan from your cash value, a loan against your policy for $25,000. And I'll preface that. You're going to take a loan from your policy whenever you want to access the money inside of there, instead of taking a withdrawal. Because you guys just saw with the math that if you withdraw money from your asset, it's going to grow a lot less. So why would we withdraw from it when we could just take a loan against the asset and let all of our money still compound? So whenever we access money in the policy, we take a loan against the policy, a loan against yourself. And if we're going to take a loan against ourselves, again, being the bank, we're taking a loan from our own bank. Wouldn't you want to pay your bank back with principal and interest? You wouldn't want to steal from your own bank, right? So let's just go find out what local car rates and loan payments are, and let's pay it back in the same way. So $500 a month would be your car payment, probably on that $25,000 car purchase. Probably going to do it for 60 months. That's 5 years. That would be your repayment to your own bank. So now let's recap what just happened. This individual saved 10 grand a year for 7 years. So they paid 70 grand into this policy. They also put in $30,000 from their cash flow, from their savings. They paid themselves back on the loan. That means they inputted into the policy $100,000, but they also took out 25 to buy the car. So really, they kind of just put into the policy 75 grand. So if they only put in 75 grand into this policy, but they have a car, look at the cash value on the bottom right there. At year 7, the cash value was call it $68,000. So think about that. You had access to 68 grand of your 75 that you put into it, and you have a car. So you didn't actually lose much money. You actually bought a car and didn't spend that much. You didn't lose that much. Well, now that'd be a more efficient way to buy the car. You're only spending 91 cents on the dollar to buy the car instead of the whole 100. You're saving money by buying the car through your own bank because you're the one making profits on the money the whole time. You're the one paying yourself back with interest. You now have access to all of that money you put into it and the car. And every year you do this, the longer and better it gets. So let's just say years into the future, this individual no longer wanted to continue saving money. So no more deposits into it. Let's just say they retired. Well, their cash value still grows. And if they take a loan from their cash value for 25 grand in that 8 year to buy a second car, now they want to get a car for a child or grandchild. Well, what are they going to do? pay it back with principal and interest, just like they'd pay anybody else. So over that next 5-year period, they would have paid nothing in premiums. They would have paid 30 grand back to the policy, and they took out 25 to buy the car. So really their net injection in this next 5-year period is only 5 grand. Again, they put in 30, took out 25. If they put 5 into it, technically. Now, how much did that cash value grow by from year 7 to year 12? It grows from 67,000 to 23. So your cash value just increased by $23,000 and you put in 5. You just quadrupled your investment and got a stinking car. Wow, right? That's mind-blowing. Every single year of your life, that only gets better and better and better because you're making compound interest. Your policy's growing. You're paying yourself back. You are the bank. So if you just do all of your financing, all your purchases, all your investments through your bank, imagine what that math comes out to be. Big numbers. There's 3 rules we incorporate when doing this. 1, you have to pay yourself first. You can't be paying other people first. You need to change your mindset, start thinking of money the right way and paying yourself first. Meaning saving money in your policy first and foremost every single month. That is your number 1 priority. Second is interest. If you guys paid yourself interest instead of paying a bank, that would be pretty awesome. That would allow you to recycle and recapture all of that money. So if this works for a car, then what else does this work for, you might be asking? Everything. That's when it gets fun. Think about this. Who wishes that they knew this earlier in life? Do you wish that you did this the last time you purchased a car? Are you going to do this the next time you purchase a car? What about the next house? What about the next time you pay Uncle Sam? All of those transactions should be going through your bank moving forward from here on out. You now know this valuable information. You can't live the rest of your life knowing this and not implementing it and giving money back to the banks. That would be just ridiculous. You now have the cheat code to being the best financier you'll ever be. Now, one more example, just to show you in a different way in case that other example didn't make sense. It's a graph. Maybe this hits home better for you and your style of learning. If you had a policy that you wanted to use to pay off a debt, let's just say you had a line of credit that you owed 9% on and $23,000. Well, what would you do in this scenario? Well, you would take $23,000 out of your policy as a loan and go pay off that line of credit. And if you pay off that line of credit, guess what that means? You no longer have to pay $289 a month for that line of credit payment. And if you no longer have to make that payment, then shouldn't you just pay yourself back? So you just use that payment to pay yourself back as if you refinance the loan with yourself. You're now, again, the bank. So guys, how many times did you make money on this transaction? Twice. Once in the policy, because all of your contributions are now earning and growing in the policy. You then took a loan against your policy and paid off a debt that was a 9%, and now you're paying yourself back at 9%. So now you are making money 2 times on this transaction instead of none at all. You now become the bank. You're making the spread on all of these different transactions. So maybe you're thinking, I don't have any bad debts. I don't need a new car. Can I still do this? Can I still be my own bank? Guys, that's where it gets stupid fun. That's where now you can be buying rental properties, making investments, lending money out all through your bank. And now only money coming back in is income, not debt. That's way better. So we have done a lot today. I'm wrapping up here, but to clarify everything, we've talked about how banks profit by leveraging your money. So just flip the script and be your own bank. Second, we've learned that you don't need to be rich to do this. Anyone can do this, just needs the right tools and the right people to help them use this. And last, with inflation and market uncertainty and economic unrest that we live in today, banking gives you the total complete control. Guys, if you want to have certainty and control over your money throughout the rest of your life from here on out, then you most definitely, absolutely need to set up a banking policy. Here's a couple things I always want to add at the end so everyone gets some reminders of all the different situations here before we wrap up. To recap, all the policy grows tax-free, the death benefits tax-free, and you now create this legacy for your loved ones so that when you pass, they just get a butt ton of money sent to them to build their bank even bigger than you could. This is how generational wealth is done. Your policies are safe and exempt from judgments and liens. The growth and the income you can get from the policy in retirement's tax-free. And you can use policies for your kids to finance college, tuition, start businesses, pay off debts, make investments, anything you wanted to do with your money, you could do through your own bank. Now, how do you fund the policy? Well, however you want. monthly, once a year, quarterly, lump sums throughout the year, literally whatever you wanted to do. Very simple. There will be a minimum you have to fund into the policy. That's always true. And I recommend that you fund the policy with a bare minimum of at least, I'd say $500 a month, maybe $800 a month to get to that 10 grand a year number, somewhere in that range, but it totally depends on your age and your situation or where we can pull other money from in different assets to fund this with. So don't take that for an exact number quite yet. I think what would be best is if you really wanted to know the minimum amount that makes sense for you, book a call with our team, go through your situation, your numbers, your goals, and they'll give you an exact plan of how you can do this. I'll give you guys a calendar link here at the end. And the maximum you can put into the policy also depends on who you are, very specific. But on top of funding the policy every month or every year, you can do a large lump sum to kind of get it started. If you wanted to, maybe you have money sitting in a money market account, a rental property you're selling, you just got a tax refund. All of that money can be dumped into the policy to get it started, and you will have access to 60 to 90% of that money right away. Immediately. You don't have to wait 10 years to access the money. You don't have to wait 5 years to access the money like an IUL. You have access to the money immediately. Again, the reason we use these specially designed policies. You can't get access to money immediately in regular life insurance. It needs to be specially designed. And when you do access the cash value in the policy, it comes out as a loan. And these loans kind of act like a line of credit. It's guaranteed. It's always available to you. There's no credit checks, no approvals. They're private. They don't go on your credit report. There's no minimums or maximums to repay the policy. It's completely unsecured and you're in complete control. So if you don't make a payment, who cares? Pay yourself back however you want. So why us? Guys, we don't charge anything to help you set this up. That's hard to get. The value in that is insane, I must say. To get a policy set up to do banking, you need a very specific insurance company, very specific design, and guidance to teach you how to use it. You don't get that from anyone in the financial space, and we do this all for free. Not totally for free. We get paid from insurance companies, so we get paid from them for bringing them the business. There is no cost or fee for you because you're not paying us to do this. We're paid from them. We're not here to manage your money, though. We're not here to pick your investments. We're not here to actually make transactions for you. You have a policy that you're running, you're using. We're just here to make sure you set it up right and know how to use it. And guys, only one of two things are going to happen to us while we're alive. One, we're going to live, and why wouldn't we be better off with this than without it while we're alive? You are most definitely better off with this while you are alive. I just showed you countless reasons why. And if you pass, when you pass, because you are guaranteed to pass, your family's not left with nothing but a problem. They're left with an asset that pays them some funds tax-free that they can then utilize to solve their banking needs for their life. Guys, don't you wish you started this when you were my age? Don't you wish you started you could start this for your kids while they're young? Don't you wish your parents set this up for you? Guys, Warren Buffett says if poor people would just do what rich people do, they wouldn't be poor anymore. Guys, you didn't come here to procrastinate. You came here to take action as you did to book and be here today. You came here to learn and implement strategies that change your family's life. Our offer today is that we will teach you all of this for free and show you how to set this system up. And I will actually meet with every single one of you individually. I opened up slots on my calendar this week to open slots for you guys. If you want to meet with me, learn how this strategy makes sense for you and go through your numbers, book time on my calendar. That is the link on the screen. That is the link I just put in the chat. It is carson.beyourownbanker.com. If you do not know how to click the link and that doesn't make sense for you, that's fine. Just put your phone number in the chat. Send it to just me, the host of the event, not to everyone so no one sees it. Just send it to me and I'll take that number, I'll write it down, and I'll call you after this. I'll make it super easy for you. Now, any last questions you have? We ended at right about an hour. That's exactly what I wanted. We're ready to wrap up. Hope this wasn't too long to take out of your day, but this hour probably will be worth millions of dollars to you and your family if you take action. It'll be the most worthwhile hour you will ever spend. So again, if you are wanting to learn this strategy, set up a call, meet with us, build a system for yourself, book time on my calendar, be at carson.beyourownbanker.com. If you have questions and you're just like, hey, this is my first time learning this, I don't fully get it yet. Awesome, even better. Let's meet and I'll give you 20 different resources, books, podcasts, all this content we have for free that you can learn from, and you can learn the strategy even deeper before you set something up, which I highly recommend you should do. Honestly, most people learning this strategy, it takes them about 5 to 8 hours of content around this from different formats to fully wrap their head around it. Appreciate all of you very much for being here and spending your Tuesday with us. Appreciate you all. I will talk to you soon. Thank you.